Welcome back to our series of talks about capital allowances. This is now our 10th video, and we're sticking with fixtures as we start to address the more complex issues that arise when property is bought and sold. Today I'm going to provide an introduction to apportionments, fixtures elections, and the relatively new concepts of the pooling requirement and the fixed value requirement. Now, if a property is sold, it follows that ownership of the fixtures is also being transferred from the old owner to the new. The sale of those fixtures is an important consideration for capital allowances purposes. Changes introduced in Finance Act 2012 became fully operational from April last year, and these require more precise and earlier attention from both vendor and purchaser. Failure to address the rules can be very expensive for either, or indeed both, of the parties. In statutory terms, we need to start near the end of the Capital Allowances Act at section 562. This section, which is still very much alive and well despite the FA 2012 changes, introduces the concept of the just and reasonable apportionment. Essentially, the section says that if several items of property are sold together or as a result of one bargain, then the sale proceeds for the vendor and the acquisition price for the purchaser must be determined on a just and reasonable basis. So, when a property is sold, it will always contain fixtures, and the legal starting point is that the amount allocated to the fixtures must be calculated on this just and reasonable basis. This is a very important principle, and there are still plenty of circumstances in which apportionments are needed. However, it is also subject to a very important proviso, the fixtures election. The fixtures election is not new, but it is now the standard way of setting the value of fixtures for capital allowances purposes when they're bought and sold. Crucially, the figures in the election do not need to be reasonable, but they are nevertheless binding on HMRC as well as on both parties to the agreement. But what of the FA 2012 rules now at sections 187A and 187B of the Capital Allowances Act? In practice, these impose two requirements in most cases. First, the vendor must, as far as permitted, add all qualifying expenditure on property fixtures to his or her tax computations before selling the fixtures on to the new owner. This is the so-called pooling requirement. Second, the two parties must sign a valid fixtures election to determine the value at which those fixtures will be transferred between the parties. This is the fixed value requirement. Now, I said that the legislation imposes these requirements, but this isn't in the sense that there are penalties for failing to do these things. However, the purchaser and all future owners will be denied valuable capital allowances if the parties do not jump through these two hoops. As there may be little or no incentive for the vendor to meet the pooling requirement, it follows that these points must be negotiated before completion of the deal. If the vendor has made a claim for allowances but does not sign a valid fixtures election, a substantial balancing charge may be incurred. So that's a quick introduction to the principles of apportionments, fixtures elections, and the newer requirements introduced in FA 2012. Over the coming weeks, we'll come back in full technical detail on all of these points, and we'll start by looking in greater depth at the FA 2012 rules.